Welcome to Matt Maley Market Strategy. And in this session, we're going to talk about what's going on in the marketplace right now. And we're going to talk about how you can take advantage of it and really show people that we're sitting at an incredibly critical juncture in the marketplace. We are in a bubble. There's no question, no doubt about that in my mind. And therefore, as we move through it, it's going to be extremely important that people stay very, very nimble and then act when it becomes more evident that this bubble is actually starting to burst. Just to let you know a little bit about my background, I've been on Wall Street for over 40 years. I spent the first 25 years of that on two of the biggest trading desks on Wall Street. For 15 years, I was at Salomon Brothers, almost 10 years at Merrill Lynch, total of 25 years, talking to the trading desks of the most important institutional clients in the world. And since then, I've been the market strategist for Miller Tabak. And one of the things that has really helped me and garnered me some great attention from the institutional community is that my trading experience gives me a great, unique view of what's really going on. We don't think about what's going on with the theoretical stuff. We want to know what's going to happen over the next couple of weeks, couple of months, and then the next year or so. And what we're going to talk about today is we're going to cover several different issues. I'm going to talk about, again, what's going on right now and what is likely to happen over the coming weeks. That's number one. Number two, we're going to just show you how we've been able to help investors at key turning points in the marketplace, whether they be short-term ones, intermediate-term ones, or long-term ones. And we've been able to do that not just with individual stocks, but with groups and entire asset classes as well. And then we're going to go in and talk about some key stocks, the ones that everybody's talking about right now, like Amazon and Advanced Micro Devices and Microsoft. We're also going to look at a couple of different stocks that people aren't really paying as close attention to, ones that could really see some big moves in the coming weeks. Obviously, the most important thing that everybody's looking at is the S&P 500 index. And, this is making another new high. A lot of people are saying, oh, of course, this definitely means that the market's going to, see another leg to this bull market rally, and we're going to be off to the races. And that may be the case. But that's what we want to watch out for, because like I said, even though we're in a bubble, this thing could last longer. It could actually last quite a bit longer. I think we're getting towards the end of that. And just because we're breaking out now doesn't mean that this thing's going to go straight to the moon here over the rest of this year. I mean, look at what's going on here. First of all, we broke out of this downward sloping trend channel. And then, then we got stuck in the sideways range. That's good. It digested the gains, and maybe we can go a lot higher. The problem is this is exactly what we saw back in 2000 when the dot-com bubble burst. And the S&P kind of trades sideways, gave some up. The NASDAQ went down more. And then the S&P rallied to a new all-time high, but the NASDAQ didn't. And then everything fell apart. And the reason why I mention that now is you look at the weekly MACD chart. You're like, what the heck is that? Well, the moving average convergence divergence. But what it is it tells us when we see a key turning point in either direction. So it doesn't say the market's overbought or oversold. It tells us that after it's overbought, it's turning over, or after it's really oversold, it's turning up. But you can see that we've seen a very mild negative MACD cross on this key index. And we saw what happened here and here back in 2024 and 2025. These MACD crosses were slight ones, just like we're seeing now, but then as things got worse, they rolled over in a significant way, okay? In both of these cases, we had corrections. Now, is this something that's just going to be a mild correction? It might be, but either way, we want to know this so we can avoid being, back in there with both feet like everybody else on Wall Street. Remember what the pros do on Wall Street, right? If there's a bubble, they have to be in it. They cannot afford to be out of it. Because if they're out, they get measured every single month, every single quarter, every single year. And if they miss a big move because the bubble's been burst, they don't care. Okay, they've got to be there. And so we need to be a little bit more nimble, because when the thing turns, it's going to turn quickly. Now we look at this thing. We talked about the NASDAQ, the NDX NASDAQ 100, which has all those tech stocks in it. There's basically 60% of this index is tech stocks, over 60, actually almost 65%. And everybody talks about how the Mag 7 is over 40%, but tech in general, over 50%. And you can see we're nowhere near making a new high in that. In fact, we're still stuck in this, what we call a descending triangle pattern. Okay, we tried to break out of it earlier this week. Now we've fallen back into it. Now, if it does break out in a more significant way, that'll be good. although it will have to break out above its all-time high and confirm what we've already seen in the S&P 500 to tell us that the bubble's not going to burst for now, that we're in 1998 or 1999, not 2000. But so we still have a ways to go. And again, the fact that it's already starting to roll back over is a concern for me. This is particularly the case because so many different companies, especially in the chip area, have reported great earnings with great guidance and rolled over. Yes, we've had a couple that have done well, like Amazon and Microsoft. That's great, but there's only two names. Other the mega cap names have sold off hard. We saw that. We've seen that with Apple and of course with Google. And so this is something that we have to be very concerned about, especially when it's happening with almost all of the chip stocks. Let's move on. Speaking of the chip stocks, here's the SOX Semiconductor Index. And this is almost exactly what happened in 2000. The SOX Semiconductor Index, okay, fell hard, okay, and it fell over 20%. Then it bounced back. Okay, this is what's happening now. But the same thing happened in 2000. And everybody said, oh, look at this sharp bounce back. It's going to be great. Well, in this case, it's the 12,000 level. You see how it broke? You can see it's a head and shoulders pattern and broke down. Well, however, it became very oversold. And so and I'll tell you how we were able to help investors profit from this decline and then tell them to be careful because it was getting oversold and not stay too negative for too long. But then the thing has bounced back, but it hasn't been able to retake that old support level. That's the the old breakout level, which was also the neckline of a head and shoulders pattern. So that old resistance, that old support becomes new resistance, and we haven't been able to break out of it yet. And so all these people are jumping on the bandwagon saying, oh, the worst is over, don't worry. Hallelujah, we're going to the moon. They need a lot more evidence before they get too excited. So be very, very careful here. If this thing fails, and God help us, if we break below the July lows at any time in the next, forget about the next couple of weeks, even in the next month or two, it's going to be a big, big problem for the stock market. And again, the same exact thing happened in 2000. This may not happen this time. Maybe this time it does bounce back, and maybe it comes later. But we are at a situation where we have too many things that are coming together all at once that we need to be concerned about. I'll talk a little bit more about that in a few minutes. But here's one of the reasons, the Treasury market. Okay, we have the Treasury market, the yields. Okay, so it made a nice double bottom in here, right? Back in late 2025 and earlier this year, trading much higher, nothing but higher lows and higher highs. We made another higher high recently. Okay, if this thing can keep going, if this thing keeps going, it's going to create some headwinds. And I know everybody says, don't worry, we don't have to be a big deal until it gets above 5%. Well, they said it was going to be a big deal until it got above 4.2%. Then 4.5%. And now they're saying 4.8 or 5%. It's like they just keep moving the goalposts. And that is exactly what happened in the 1987 crash. This is exactly what happened in 1987. I remember it well. I was at Salomon Brothers covering the most sophisticated institutional investor at the time, Harvard Management. And we saw what was portraying is that everybody saw interest rates moving higher. Everybody said it didn't matter. And then, of course, it didn't matter until it did. And that's what happened on so many different occasions in the past. Everybody says, yeah, geez, it's no problem, no problem, no problem. And then afterwards, only in hindsight, did they realize that the increase was important. And just look at what here. I mean, some people say, well, geez, interest rates were, my grandparents bought a house, interest rates were, 15%, 20%. It's like, who cares? Look we have interest rates, long-term interest rates at their high, much higher than the average of the last 20 years. And in fact, if you go back to late 2007, we've literally, yields have only been higher 0.25% of the time. That's right. 4 weeks out of over 1,500 weeks has the yield been higher than it is right now. And so people don't care about where their grandparents paid for a mortgage. They're looking at it going, hey, we could afford that house when the mortgage rates were at 6%. Now they're approaching 7%. We can't afford it. So it doesn't matter what the grandparents paid. All right. So this is an issue. And this is a significant increase in yields. At some point, it's going to have an impact, and it will only be obvious in hindsight. And that's just one other thing I'd add. And just another thing to mention, we always hear some of these pundits talk about how we don't have to worry about things until credit spreads start to widen out. Well, I hate to say it, when the credit spreads finally widen out in a meaningful way, the stock market is already down 15% on its way to a much worse decline. So if you wait for that, you're going to get kicked in the teeth. Right? And so we had, and let's face it, credit spreads are starting to widen out already for the hyperscalers. And everybody says, well, they're not in the danger of, being a real fundamental, a systemic problem. It's like, what you don't have to have a systemic problem for it to cause the market to go down. I mean, I remember back in 2022, the beginning of the year, when I was saying that tech stocks are in trouble, and everybody was saying, don't worry, the bubble's not as big as it was back in 2000, so therefore the tech stocks won't go down. And I was like, no, the Fed is tightening, the market's going to go down. It doesn't matter. You don't have to have the worst bubble in history for it to have a profoundly negative impact on the market. The same thing happened when you compare the tech situation. The same thing happened when you compare these fixed income issues. Okay, so how have we been able to help people? And so let's just go to the next issue here. Here's something that we talked about just at the end of May. Everybody's talking about how the Kospi index in South Korea it was a problem and was a big warning flag, a big canary in the coal mine. Nobody was talking about it in late May except for me. All right. And I talked about it here again, May 31st, where we talked about how had been coming down, how what some of the technical moves in that were very negative, and especially because they've become the most overbought it had been basically ever. Okay, so it was something where I draw that similarity, and it wasn't until a couple of weeks later, or actually a couple of months later, before people really jumped onto it. But I was able to warn investors in advance. So that's what I did with my weekend report, my weekly insights. Okay, so and this is what I was talking about. See how it became incredibly overbought here, each of those times, each time. Okay, and see how it was trading above its 200-week moving average. 76% above, 447% above. This was 257% above. Right? I knew this thing was going to come down. And sure enough, it rolled over and the stock market got hit. But again, here was a situation where, boom, back here, I talked about it on May 31st, where I kind of laid the groundwork, but said, be careful. And then a couple of weeks later, we were talking about it in our sister publication before the opening, the one that we put out every single day. Again, we put out a note every single day, Monday through Friday, and then on the weekend we put out a little bit more detailed report. And they really work very well with each other. And again, this was something that we said, hey, with the South Korea stock market really starting to roll over, this is going to have a negative impact on the SOX semiconductor index. And sure enough, all right, SOX semiconductor index, boom. But literally the time we made that call, stock dropped 28% over the next 5 to 6 weeks. So people who took profits from there did very, very well. Those who bought puts, whether it be on the ETFs, the semiconductor ETFs, or on the individual stocks, did way better. And then sure enough, when it became oversold, this is the relative strength index, it became oversold. We said, hey, be careful. This is getting ready for a bounce. So be careful about making negative bets down here. And sure enough, we've seen a bounce since then. So these are the types of things that we talk about in the Maley Report every single day. Well, just to give you a couple more examples really quickly, but again, something from our weekend piece. Back in June, we talked about how the IBB, the biotech stocks, were about ready to break out. And of course, we know that the market right now is totally driven, I'd say, not solely, but very much driven by momentum. And we knew that if these biotech stocks broke out to the upside, it would be very bullish for the group. And we highlighted that in our weekend piece. And sure enough, you could see what we were talking about. It was trying to break above that key resistance level. At the same time, its MACD chart was curling up and about to make a positive cross. And we saw what had happened the previous times. So the stocks, the ETF rallied very, very strongly. Well, sure enough, boom, the thing rallied 14% in just a couple of weeks. Then, okay, again, for longer term investors, they got in. It's a little bit tougher to play, but for short term traders, and even those who are trying to, play with their portfolios and go in and out, which is so important to be nimble nowadays, it was still very helpful. But then it got very, very overbought. See, again, on its relative strength index, and we said, back away. Let's back away. Sure enough, it fell 7%. Now, of course, it didn't crash or anything, but it's stuck in a sideways range now. And actually, we'll be talking about this issue in the Maley Report going forward, because this went through the end of last week. It's starting to bump up the top end of that sideways range again. If it can break back out, it's going to do well. Again, I'm worried about the market rolling over here, even though everybody's saying that the recent rally is going to definitely have legs. I'm not so sure it will, but if it does, this will be an area we'll be jumping in. We'll be talking about this every day. Okay, and just another example here, real quickly from last year that worked out extremely well. Way back in June, when nobody was talking about it, we talked about, again, our weekend insights back on June 5th of last year. And we talked about how the silver and gold were about to break out. However, we also highlighted that silver, which had been lagging behind gold all year, should outperform gold in a significant way. Again, this is the direct quotes from June 5th. And sure enough, this is what we were talking about. It was trying to break out. It was only $35. I mean, it's come way down. It's already still holding up, well above 50. Okay. But again, we talked about whether it be MACD charts, we other different, we use MACD, but we used many other indicators, and we had a couple of other ones that were very helpful. But you can see how it broke out, and then boom, what followed there? See back here? I'll go back. See back in June. Oopsie. And back, this is when, this came out in June. This is the number we called in June of 2025. And then, and then from June to July, 252% rally. And then it got very, very overbought. So we got a little careful there. We actually got careful here too for a short-term basis, but we still thought had more to go to the upside. But then we came in and said, it's gone way too far. It's way overbought. And again, this is, earlier we talked about on our weekend piece. This was on our daily piece, literally on the day that silver topped on January 29th of this year. We talked about these RSI readings, also talked about some of the sentiment readings we look at, and we said these things could see a decent pullback of some substance quite soon. Well, sure enough, after that 252% rally, boom, it fell out of bed. So I would definitely, and the people who were following our work in the Maley Report did extremely, extremely well. Okay, that's enough of, pat myself on the back anymore. I'm going to dislocate my shoulder. But it just gives you an idea of how we're able to help investors, both with longer term investments and with shorter term trades. But what's going on right now? What are we going to be looking at on a specific basis? I've talked about some of the macro issues that are a concern to me. But again, these things could turn higher at any time. And one of the things we're looking at right now, of course, we want to cover a couple of stocks that everybody looks at all the time. One of those, of course, is Amazon. Now, this is the weekly chart, and the stock is trying to break out. Of course, this is one of the few that was able to respond very well to its positive earnings and guidance. And of course, it's rallied up nicely. And it looked like it was really going to break out here with a nice higher high, but it's already pulled back. That's okay. That doesn't mean it's going to fail, right? Because we see what's happened here. It's just seeing a very mild positive MACD cross. When things see that they're going to see a change, when a stock indicates it's going to see a change in trend, we need to see a compelling move. See right here, that was saw a positive cross, but it didn't last. It lasted 2 days, right back down. I'm sorry, a week and a half, and right back down. Okay, right here looked like a breakout, but it was right back down. So we got to make sure that this is going to be a compelling one, like it was here and here and here, which turned into big rallies there, and there. So we're at this critical juncture, and it's not a shoo-in. I know that everybody on Wall Street feels it is, but again, just to go back what the pros do, and I don't blame them, but you see, the pros who work for some of these bulge bracket firms and work for the people who manage money. I mean, their job is to be bullish because they want people to keep their money there, right? And the people who run the money, I don't blame them. Markets usually rally, but if the market is rallying in a big way, as Chuck Prince said right before the great financial crisis, he said, "Hey, if the music's playing, we got to dance." In other words, the music's playing, we're making money hand over fist. We're just going to keep doing it until the music stops, and that's what they're going to do. And again, I can't blame them because they can't afford to miss the move because they get measured every single year. And if somebody else stays with the rally and you back off from it, you're out of trouble. Well, the thing is, we as individual investors don't have to worry about that. You can't fire yourself, right? But so if you miss a little bit of the move, it's okay. And the only other thing I would say is that you don't have to go to 100% cash. Okay, you can miss a little bit of the move and then see that, okay, I was wrong, and go right back in. Right? The pros cannot do that. They have to be in all the time. So be careful when they're constantly bullish. And once in a while they say, "Oh, we could see a pullback at any time." But we're now at a situation with what's going on with this AI bubble, and we could talk all about the question of return on investment on those. With interest rates where they are, what's going on geopolitics, uh, and the situation with the change in the Fed, which is a little question in my mind that the Fed put is further out of the money than it used to be, and Kevin Warsh is not going to be quite so quick to bail everybody out. The next, the next decline, we're going to have a bear market at some time, right? At some point, right? We're going to have another recession at some point. It may not happen for a while, but when it does, a lot of people are going to be caught way off sides and they'll be buying the dips all the way down and they're going to get hurt. Okay, let's move on to the next one. Advanced micro devices. Now, here's one again, one that reported great earnings, great guidance, and the stock went down. What's really got me concerned right now is see this weekly MACD cross? Okay, look at that. All right. Look at what has happened the last bunch of times. Now, it's not, again, it may be a head fake, but if it becomes a bigger one, the last four declines, 29%, basically 30%, 46%, 32%, and 66%, which was the bear market, of course, of 2022. By the way, we called that bear market very well. And, again, we were able to help investors in a fabulous way. But right now, so what we're watching very closely, if we see much more weakness in this, and this becomes a more compelling cross, it's going to confirm that a change in trend has taken place, and we're in big trouble. So this is something that people need to be watching very, very closely. Microsoft. Now here's one. This is a great breakout. All right, but look how overbought it's gotten. See on these things, got that overbought here, fell 11%. Okay, 11% is not the worst thing in the world, but 16% there, only 8% there, but 25%. But my point is that if you are an institutional player and you want to jump back up the truck, this is not the time to do it. Doesn't mean you have to dump the stock or buy puts or get short the name, but it's something you want to be careful about. And this is what we're going to be watching. Does this thing, this breakout level, does it hold? If it rolls back over and holds that level, that's going to be good. If it breaks below it, not so much. I'm a little worried about Microsoft, again, with the software business, but this is what we're going to be watching. These are the levels you have to be watching for right now, because the odds of this thing breaking 500 right now are low. Much more likely, even if you're really bullish on the stock, you're probably going to be able to pick it up down near $460 rather than buying up here. Whether you're a long-term investor or a short-term investor, this is not the time to be buying. Not when a stock is the most overbought it's been in the last 2 years, and when it was even less overbought, it saw meaningful pullbacks. These, again, types of things we talk about in our regular pieces. Another stock right now is Micron. Okay, excuse me. It's a head and shoulders pattern, and it's testing that neckline. It's neither overbought nor oversold. So again, I'm not going to jump on this one either way. I'm going to wait till it tells us which way it's going to go. But this one, head and shoulders patterns are some of the most bearish there are out there. And if the tech sector does get hit, because again, it's a commoditized business. So this AI thing is commoditized. And I know they say that the chips are no longer going to be, economically sensitive. I've been hearing that for 40 years. And it hasn't worked out since, so we need to be very careful about it now. That's why I feel that this is probably going to resolve itself to the downside. But until the market tells me that, I'm not going to jump all over it. But I got to tell you, most people won't be doing it until it gets down to 400 or so. We'll see what happens. But that's a key stock. These are the levels we're going to be watching in our report. Now, another stock is a Palantir. What's going to go on with this one? It was the darling of last year, but it's had a rough run over the last 10 months, but it's bumping right up against its key resistance level. This is one of the stocks that has been able to rally after they reported good guidance and good earnings, but it still is bumping up against that level. And if it cannot break above this level, just above 160, it's going to be a problem. And you can see that when it's got as overbought as it is now, it's been followed by sharp declines. Sharp decline there, sharp decline there. What happens this time around? Don't know. Okay. But this here, lower low, lower high, but then boom, that's nice. So if it can break out, it's going to go. So if I'm wrong that the bubble's not going to burst for a while, this thing could run. But again, This is something we're going to be watching very closely, and we'll be talking about it, and you'll be able to take advantage of it when it does. And then just one last one here that people just don't think about very often. This is one of these technology stocks involved in the defense industry, and it's been beaten up for a long time. All right. But now it's finally broken out of that downward sloping trend channel and trying to make a higher high. End's trying to show that it's confirming that it's going to be a positive change in trend, because obviously the trend's been down for almost a year. Right? But we need to see a little bit more. But again, this thing can break above 60 in a more meaningful way than it did yesterday. It's going to run because it'll get a more, again, it's momentum-based money. And is the world getting any safer? The world is not getting any safer, not at all. So that's one to really look for there. So you can see that we look at a number of different things that really work well for us in the Maley Report. I don't know which way for sure it's going to go, but I know that the next 20% move is going to more likely be to the downside than to the upside. I just don't know when it's going to start. But these are the things we talk about every single week. Thank you for joining in today. And for information like this and more, it's available at themaleyReport.com. Click on the link in the description for a 10% discount. And be sure to like and subscribe to see more. Thank you very much.